Welcome to the Daily Update. This is being prepared Sunday, September 25th, where we'll look at the action in the market for the previous week, the week of September 19th through the 23rd, and then we'll see how things look for the week of September 26th through the 30th. And we're pretty negative. The daily charts are pretty negative. The weekly charts are turning a lot more negative, but the market could be at a potential place to get some kind of a bounce. Now, it may not even play out that way, but we're seeing a real convergence based on sentiment, based on the charts that we're looking at, based on the fact that we're coming back down and testing the June lows. We might get some kind of a bounce out of that. Everything is pretty much negative right now. That can also be turned around and used as kind of a contrary indicator. I've been listening to a lot of podcasts. I've been, of course, watching and reading about the news. Everybody's just down on the market and is pretty much convinced that it's going to go lower. A lot of times that's when we see a bottom or that we get near a bottom at that point. But we need to see confirmation in price. Until we see some real up closes, it really doesn't matter. We have to see some follow through. Now, on the positive side, we're seeing some early weakness most of the days, and then some late day buying. And that's a common trick by the smart money. When they're getting ready to position themselves for the market to go higher, we see this pattern. Now, take out the day when the Fed made their announcement. That was all crazy in and of itself. But I'll show you on the chart where we're seeing early weakness, late day recovery. That could be positive. We're not seeing really anything technically other than that right now that is suggesting that we could go up, but we are very oversold, especially in the short term, even in the intermediate term on the daily charts. We're becoming more oversold in some of our weekly charts, and that could give us some support as well, but we can't really act on that until we see some follow through movement to the upside. So let's go back and talk about the week session. I have two slides to go through here. The S&P was down 4.6% for the week and down 6.6% for the month so far in September. And we're not even done with September yet. A lot of banks, not only in the US, but around the world, they're raising rates. Now, they did something a little different this past week in the UK. They're trying to stimulate their economy there, and they announced a tax cut. It's like, okay, well, that could be cool. First time they've done anything like this since 1975. The only problem is, in order to finance these tax cuts, they're going to have to raise more debt. And once you kind of see through to the other side of that, it really wasn't taken as very positive. The reason for doing this is to try to stimulate growth and try to get ahead of inflation if possible. As you're probably well aware, the FOMC on Wednesday raised interest rates by 75 basis points. We're right in the 3 to 3.25% range now. And then another thing that was negative that came out, there's a place called the Summary of Economic Projections, I guess SEP. They had been saying for 2022 that the rates, as the Fed are raising them, they're going to go to 3.4%. Well, we're kind of above that, really quickly now. Now, what they did is they project that they'll see a rate of 4.4% for 2022, and that's the median. And then for 2023, they see it going up to 4.6%, where they had said it was going to be at 3.8%. So you can see they're notching interest rate projections higher. This could have a real impact on not only us as consumers, but companies too, because it's costing them more to borrow money. And they're seeing growth in their earnings, they're seeing a real decline in their earnings per share growth right now. And that is ultimately what feeds through into stock prices, is how much can a company earn. Then they say the median rate for 2023 is 3.9%, and that there's unlikely to be a rate cut in 2023. So the scenario that inflation is topped out, starting to come back down, this will mean that the Fed can step in and lower interest rates. we've been whipsawed by that at least 4 times in 2022. Well, now they're coming out in different areas and also with the Fed saying that's not what's going to happen here. In fact, I have some other comments by Chair Powell. After they made the announcement on Wednesday, he gave a press conference. And to quote him, it says, restoring price stability will require maintaining a restrictive policy stance for some time. They're going to keep raising interest rates. That's really what that means by restrictive policy stance. The historical record cautions strongly against prematurely loosening policy. And that's what the market's been trying to anticipate when we've seen the nice little bounces in 2022. That's what the market's trying to say, that, okay, we think the Fed's going to start loosening, or they're going to become more dovish with their policy. And Fed Chair Powell just keeps coming out and saying, no, 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 that's not what we're going to do. And the markets have then go back down, and oftentimes we hit new lows after that. And it's really created this bouncy, very hard to navigate market environment in 2022. Then he went on to say that the Fed will get to the 4.6% rate relatively quickly. So they meet again in November. And so they're probably going to boost interest rates again at that time. And they're trying to get back down to a target of 2%. Okay, now even if you take CPI, what it is now, to 8.3% or so, they got their work cut out for them to get back down to more of a neutral rate. And he said that it's likely to cause pain as we're raising interest rates, you think, because this will inevitably contribute to a weakening in the labor market. That's what a lot of people are using as justification to say that we're not in a recession right now. Look at the employment situation. Well, if you look on some of the different websites out there, you're starting to hear some rumblings about layoffs in certain high-tech companies and things that are kind of going under the radar by the mainstream media. And this will eventually feed over into some of the data that we see and show that maybe the employment situation is starting to weaken. Until that actually happens, we have this real mix of the economy seems to be slowing down, but employment has been holding up. Well, maybe that's starting to change, but we're not seeing that necessarily in the data right now. We have a fear of large cuts. This will eventually get over into the earnings, and that's ultimately what helps to determine the price of stocks, and that will lead to broad-based selling if they have to lower their projection of earnings. Another slide that I have here, the US isn't the only market that's dealing with inflation. This is happening worldwide. And over the last week, the Bank of England, they raised their rates 50 basis points or 0.5%. So did Norges Bank in Sweden and the Bank of Indonesia. And also, for the first time since 2015, the Swiss bank has raised their rates. They raised them 75 basis points. They had been negative. They had been below zero. Well, they raised it 75 basis points, and now they're at 0.5%. So this is just another real shift that we're seeing. This is, people have gotten used to things being this way. We've lived in a low inflationary environment for decades, and now we're starting to get into a high inflationary environment. We're already in one, and you have money managers, you have people that make a lot of decisions, you have investors who are used to doing things a certain way, and now that whole paradigm is starting to shift. And it's not just happening in the US, it's happening worldwide as well. Also, the Bank of Japan, they didn't raise their interest rates because they're in another problem that they're having. They kept them unchanged at minus 0.1%, and they don't expect to raise them at any time soon. This is really causing the yen to weaken, because if you think about it, if interest rates go up, that makes it more precious to have a particular currency, whether it's the dollar or the yen. And the yen has really been falling against the dollar. And so the Japanese Ministry of Finance tried to step in and give support, saying, we're going to go in and buy lots of the yen. Well, they had to do this back in the late 90s, in 1997, 1998. There was a thing called the Asian currency crisis. Some of you may remember that. They haven't done anything like this since then. Well, it's really not helping right now. It's helping the yen bounce up a little bit, but it's not really giving a lot of support, at least as of yet. Then for the week, the dollar, man, it was up 3%. It just continues to go up and up. And again, it doesn't mean that the dollar is all that great and wonderful. It's just the least crappy of all the currencies out there. You might be able to make a good case for the Swiss franc, but since so much of the world commerce is done in dollars, at least for the foreseeable future, they're trying to change that in some areas. Having the dollar go up, that is helping the currency be more valuable, but then that's also hurting companies because what is it, 40% or so of, or S&P 500 companies do about 40% of their business in other countries. And the conversion rate works against them if the dollar is strong because it doesn't look like they have as many dollars on their books. Also, it really produces an imbalance with the export-import process that goes back and forth. So this could also feed over into their earnings. And as we see the dollar going up and stocks going down, that's also providing another headwind with the dollar strength. Then on Friday, the Dow actually took out its low that it set back in June. The S&P went down to the low that we set back in June, but we were able to bounce up off of that. And the Dow is just 30 stocks. And I know that's what the financial media likes to talk about. And they say it's up 1,000 points, down 1,000 points. If you watch my videos for very long, I don't deal in points. I deal in percentages. So I like to look at the S&P 500. I think it's a broader measurement than all the strategies that I teach and that I do are based around the S&P 500. Well, because it's 505 stocks instead of 30, then we can use this as a better barometer of the stock market. And the fact that it held, and actually we saw some late day buying coming back in, that could really add some support. Now, is it really going to follow through into support with some significantly higher prices? We don't know. Are we even going to get a bounce? We don't know. There's some evidence to suggest that, yes, we could be seeing a bounce because we're getting oversold in the short term. Fear is really coming together as far as freaking out right now. And I'll show you what I'm seeing, a little pattern in the intraday chart that I'll go through here in just a moment. Goldman Sachs also came out and said, remember when we thought the S&P was going to close the year at about 4,300? Well, you might want to erase that number and put 3,600 into your little column. And if we really start to hit hard times with the economy, they see the S&P going down to 3,150. So, okay. Now, let's go back and talk about some other things. The S&P was down 4.65% on the week. Volume is above average. It has been picking up since Labor Day. The technicals are just negative. There's some positive parts here and there that you can look at, especially on the daily charts. We're pretty much pointed down, but we're also extreme down on many of those charts. And I'll go through and show you the weekly charts. Inflation and interest rates, that's what everybody's fixated on. Of course, we have the whole geopolitical concerns. There's more rumblings coming out of the Russia-Ukraine situation that could potentially at any time escalate things. They're still doing lockdowns in China, and there's still supply chain issues the companies are having to deal with. Oil has actually been coming down, and that's more of a political trick right now because we're coming up to an election, and they've pretty much not depleted, but they've sucked a lot of the emergency reserves that we have and flooded that out into the markets and some foreign markets too for some reason. And that has helped to bring the price of gas down. Because if politicians, the games that they play, if gas prices are coming down and this person is in office, you might think, well, I might just go ahead and vote for that person after all. Well, it's being done more artificially and more short term. And it could potentially back the US into a corner because if something big militarily happens, that fuel that's been flooded out into the US is going to be needed by our military, and it might not be there. And even if that doesn't happen, that fuel is going to have to be replaced, and it's a lot higher prices now than it was back then. We might be getting some more Fed speak at any time, but the one to really pay attention to is if Chairperson Powell is the one that says anything. Earnings are coming out just kind of on a case-by-case basis. And then when I talk about the recession debate, I kind of just said, okay, what's your current situation? Are you in a recession right now? Are things getting better for you right now? Are they getting worse? Are they staying about the same? If they're getting worse, or you're starting to struggle and see a lot higher prices, then yeah, you're probably in a recession, no matter what they do to twist the definition of that meaning. Our trend is still, it's weakening slightly with the ADX, but it's still negative with the red line on top. So here's the intraday chart. And actually, I want to go all the way over to the left and show this was the last part of Friday. It was the 16th, where we saw some late day strength going into the close. All right. Then on Monday, we saw some weakness and then late day strength. Tuesday, gapped lower. We're going down, down, down. We saw late day strength. This is the smart money coming in to buy. Wednesday, we can just cross off because all this gyration here, this is after the Fed raised interest rates and the market just shot all over the place. On Thursday, we were pretty much flat overall, but then we saw late day strength. Friday, we really gapped lower. We went down to almost S4, which almost never happens. But you notice there's some late day strength. This is bouncing up off of the support. Now, this is often what the smart money will do as prices are going down. They wait for the amateur hour to end, and then the last 1 to 2 hours that the markets are open, they come in and they start buying, because at some point they think we're going to hit support and actually turn around and go higher, and they're already well invested. For the week, the Dow was down 4%, the NASDAQ was down 5.1%, the S&P down 4.6%, and the small caps here measured by the Russell 2000 was down a whopping 6.8%. And this is just a chart showing how we performed over the last week, index by index. The mid caps did the worst, but it's kind of interesting. When we were seeing the little positive things happening a few weeks back before Jackson Hole, before Chairman Powell made that speech, the mid caps were actually doing quite well. And on our daily charts, the mid cap index has been holding up the best. Well, now it's starting to really decline and is not looking all that strong right now. This is going back to the all-time high set earlier in the year with the S&P. That's the pink area here. And it just shows how the NASDAQ and NASDAQ 100 have been leading the way lower. They're both down over 30% from that all-time high. But if we turn around somehow, some days, maybe, and start going back up, we'll probably be led by the NASDAQ and the NASDAQ 100 going higher. Looking at the sectors, they were all down on the week. With energy, which that's been the best performing sector of 2022, it was down 9.16% just in 1 week. Discretionary, which had been kind of stealthily doing a little bit better, it got hammered more than 7% in the past 5 trading days. And real estate, which we're starting to see some follow through weakness with that. Housing prices are still going up, but interest rates are going up. And so we're seeing mortgage applications and refinancing really starting to drop off. And a lot of people are just getting priced right out of the market. And so this will eventually feed over into the housing sector, and we could see real weakness in that area. Then this is going back to the just the last 5 days, showing how the sectors had performed, with energy being down the most. Current market valuation still has us unfairly valued. This is the aggregate score. This is taking all the charts that I'll show you after this and cramming them all together. And it has us below the yellow line, which is 1 standard deviation above. That when we get above that, then we're considered to be overvalued. When we're below this, we're fairly valued, but we have not gone negative yet. We're still above the black dash line. Here's the yield curve model showing a week ago we had been slightly above this, so we were a little bit overvalued. Well, we've been coming back down now, more into a fairly valued region. This is the Buffett Indicator. This takes stock prices and GDP and compares them with each other. And this historical trend line, when we get too far away from that, then we're considered to be overvalued. Well, we've been coming back down below this one standard deviation. And so we're back into fairly valued territory. This is the PE ratio, price to earnings ratio. It's also coming down below the yellow line, so it's considered to be fairly valued. Now, this one looks backwards. This is looking at trailing earnings reports. They tend to be a lot more optimistic when you go forward from here. And that's what the stock market uses, is what it thinks is going to happen in the future. But it also really helps us to get a historical perspective to show where are we at in terms of where we've been at historically. And right now, we're just slightly into the fairly valued camp. Interest rate model, even though interest rates are going up, they're still historically low. And we're right around the black dashed line here. So we're considered fairly valued. Margin debt was finally updated for the end of August. And it shows that we're undervalued. And that makes sense. With the market going down, people buying stocks on margin because they have to pay whatever they borrow back. If you use $5,000 to get into a stock position, even if your stock just tanks, you still owe that $5,000 back to your broker. And so when markets go down, there tends to be a lot less folks using margin. It's great when you're right. It can be really uncomfortable and nasty when you're wrong. Here's the reversion to the mean model, where how far away are we from this historical trend line? We have become way up here at extremely overvalued. Well, as the S&P has been coming down, we finally dropped below the overvalued line, and now we're getting back into the fairly valued line. Looking at sentiment, this is as of Friday's close. We're starting to get over into the extreme fear category, and that could be used as a contrary indicator. Now, we still have some more room to fall here, but it is getting more fearful than what we've seen in quite some time. In fact, here's the historical chart. We finally just dropped below 25 for the first time since July. This is the active asset managers, and this is a week old, even though this report came out on the 21st. It's for the previous week. It's also showing that they are pretty extreme negative, and it probably dropped in the latest reading. So this can also be used as a contrary indicator. This is part of the sentiment that I've been talking about. We're seeing the worst outflow episode for European equity since 2016. It's just people are scared, not only in America, but they're scared in Europe. And so they're yanking money out of the stock market, and they're going to have to find a way to pay for their heat and pay for their food. And so they're taking money out of the stock market. So overall, we're seeing outflows rather than inflows. Here's the Ridex bear bull ratio, the latest reading I have as of the 22nd. That was Thursday. It shows that more people are starting to get into the bearish funds rather than the bullish funds. And then we had the weekly survey of American Association of Individual Investors. This can also be a potential contrarian indicator where the individual investors are getting very, very pessimistic. Now, we've been down here before, bounced up a little bit, and have come right back down. This is like the third bounce now that we've seen at this level. But taken together with other things that we're seeing, this may provide some support for the market, at least in the short term. GDP now. Well, a couple weeks back, GDP now was at 1.5%. Then they came out, they lowered it to 0.5%. They updated it again, and now they're down at 0.3% for GDP growth. It's still positive, but what do you think is going to happen if we see more weakness? Could this easily turn over and go negative? And that's part of the definition of a recession. Then we're still hanging in there as far as the spread between risky bonds or debt instruments and non-risky assets, where it's not really spiking up yet, where a lot of other times when we've had really difficult times, it has spiked up. In fact, this one has actually been going down. Here's the Chicago Fed showing our financial conditions index. As long as it's below this black line, things are not getting too crazy, according to this chart. Now, you're going to bring up 100 other charts that show that we are going crazy, but this is the one that I typically will look at and talk about in each video. Here's another Isabel Net chart. Again, just giving us an idea of what kind of drawdowns can we look at when we've been around other recessions, and they went all the way back to 1947. It shows here where the low that we set in June at 36.67, that was when we were down 24%. Well, if we could even fall further, and this is getting more down to the Goldman Sachs area of 31.50, that would take us down about 34%. This is just showing the path of the S&P 500. This is when they made their change at Goldman Sachs, where they thought we were going to end right around 4,300. And they still think if we have a soft landing, which, my goodness, it's just not looking all that likely that that's even going to happen. But if it does, they think that we'll end at about 4,000. Then they've been lowering their projections for the S&P. Here down here is the 3,600 again. And that's still assuming that we might have a soft landing, meaning that the Fed isn't going to raise interest rates so much that it really ruins the economy. If we have a hard landing, which is kind of more likely what will happen. I'm not an economist. But I do keep an eye on these things. If we do have a hard landing, we could see even lower prices in the S&P, down to 3,400 in 2022, and then only up to 3,750 in 2023. These are just projections, but there's a lot of folks that use these to make decisions. We're also getting to the point where we're bullish with the insider transactions ratio, and that's really been dropping lately. And this is legal insider transactions, not the illegal kind. This just shows that the dollar can remain strong until the peak in the US 2-year Treasury is reached. Now, in every single daily video that I do, we look at the 2-year yield. We don't know when that's going to happen, but we're keeping an eye on that. We also watch the dollar index every day, and it's been going up. The 2-year yield's been going up. At some point, when the 2-year yield tops out and starts to come down, that will give some support to stocks. That's one of our possible positive scenarios. Well, that would mean that short-term interest rates are coming down. And so that just kind of makes sense, but we don't know exactly when that will happen. This is 20th century versus the 21st century PE ratio. This is just showing where we were at, big secular turning points in bond yields. Bonds are just getting smacked and continue to get smacked. In June of 2021, we really topped out here. Right now, we're right around the 19 times earning. This is just slightly under being expensive right now. And you can see what it was during World War I, during the Great Depression, during World War II, the oil crises that we had in the 70s, the early 70s and the late 70s. I lived through that one. And then the Euro debt crisis that we had back in 2011, and just how things are acting. This is also suggesting that we're seeing the third great bear market in bonds. Thus far, a doozy. Okay, the first one they have going 21 years from 1899 to 1920. Of course, there was a little thing called World War I that happened there. Then the second great bond bear market. This was right after World War II, which ended in 1945 and went all the way up to 1981. And now they're saying that since 2020, we are in the third great bond bear market. This is where folks like to go to for safety. When they're not really happy about the stock market, they often will shift their money from the stock market over to the bond market. Well, the bond market's not really doing all that good either. So this is the problem that people are having, is where do we put our money? We can't put it in stocks because they're going down. We can't put it in bonds because they're going down. Oh, I got a good idea. We'll put it in crypto. Well, that's been crashing too. Okay, well, how about gold? Well, that's been going down. It's like there's no real strong asset class other than the US dollar. And even oil had been stronger earlier, but it's really starting to come down now, and it's being manipulated lower. So it's really a confusing environment for a lot of folks right now. This is the Morgan Stanley, their price target for the mid-year of 2023. If the bull case, which means things go nice and good and the earnings per share is around 244 with an 18.2 multiple, then we might get back to 44.50. All right. Base case, earnings are at 220 with a PE ratio of 17.7. We get to 3,900. bear case where earnings per share really fall, especially down to 205, we'll be down at a 16.3 PE ratio, and that would take us down to 33.50. And from the time they did this, that would be down 13.5% from where we're at. They're basing this on 38.73. This was done as of September 16th, so it's a little outdated. Here is some Factset headlines that I have here. This just shows the stock 600, which is Europe. That's one of their indexes. European energy steaming ahead as Europe continues to report strong growth. Well, that might change here a little bit, but you can see down here on the chart where they are showing some growth overall over on the right-hand side, but that may not last too much longer. Then I have just another headline here, and this is kind of like, what? Industry analysts project more than 25% increase in the S&P 500 price over the next 12 months. Okay, kind of really hard to believe right now, but there are industry analysts out there that think a year from now we're going to be 25% higher than we are now. Could always happen, but it just seems not all that realistic right now, but yet anything can happen. Here's the VIX, where it did come up on the weekly chart. So as we're going down, people are hedging more. So we're seeing the VIX close lower, and we're seeing a bit of a spike up with the bar chart. The Ulcer Index, after coming down to the moving average, as we're falling, fear is starting to increase. I'm not updating the possible positive scenarios. In fact, a lot of them are going back, and they could potentially be setting new signals that we were working off before. Looking at earnings, this shows on a historical basis, we are still overvalued. We're at 27.65 after Friday, where we should be between 16 and 17 right now. So on a historical basis, things are expensive. And I'll stop doing this after this video because we've got a ways to go until November 2nd. After the meeting and at the end of the session on Friday, there's a 72.9% chance that the Fed is going to raise rates another 0.75%. And I'll keep an eye on this. And if things get really crazy, I'll start to show these again. But we've got a little bit of time now to wait on that. Here is the recent look at the Fed balance sheet, how it's rolling over a bit as the Fed is starting to either let some of their bonds that they bought, a lot of their short-term bonds, they're just letting those expire, and they're trying to lessen the amount of bonds that are on their balance sheet. Looking at breadth, really seeing a decline, and you can see where we're coming down based on price. We're actually going a little bit lower. We're seeing kind of a negative divergence here based on volume, where volume is leading price down. This is pretty negative overall. Some positive from this chart. We've gone down pretty fast. So this moving average and this moving average are still having a tendency to go up, but we need to see some real bounce for this chart to look more positive. Our advanced decline ratio is negative and declining. New highs, new lows. Just look at us, bam, just really going down big. We didn't even, let's see, this was the COVID low here. We're down below that and hitting new lows right now. And we've just been chopping all over back and forth right in here. And we're really showing an expansion of new lows currently. Accumulation distribution is just slightly below the moving average. Looking at our trend, where we are just trying to come back above the moving average. And we haven't gone above that. So that's why I say it's weakening still. But the red line is on top. So we are in a trending environment. The red line's on top, so it's negative. And it could be getting stronger, but it's still not quite there yet. Our Arun is flat and really not giving us any indication now. The mass index not telling us anything right now. This is the latest from Decision Point, where they have their short-term trend model neutral, but everything else is looking at a downtrend currently. This is a daily chart showing how we came down to the June lows, and this could be positive. We came right down to this level, bounced up, and then you can see it right where the cursor is. That's about where we closed on Friday. Can we get some support up off of this, from this? You can also see how volume has been picking up. This is the trend channel where we did break down below that. That could be negative, but there have been other times when we've broken down below this channel only to be able to recover from that point. The pivot points, we continue to be below S1, and we have a lot of open space to get down to S2. We're well below the 50-period moving average, and then you're just going to hear a broken record here. The long-term trend is negative and declining. BPI starting to get extreme negative. Chaikin oscillator declining and not quite extreme negative yet. Chaikin money flow just ticked down ever so slightly. The force index is declining. McClellan oscillator starting to get extreme negative. The summation index is really declining based on price and volume and not necessarily extreme yet. We could go all the way down to these lower lines. The oscillators, the slope is finally rolling over, but all of our other, well, I guess we have the KST and the tricks, they're still pointed up. It takes more for them to move. So some of our shorter term oscillators are starting to roll back over. Swindling trading oscillator starting to get extreme negative based on price and volume. And we're seeing this on the daily chart too. The PMO, which is rolling over, getting extreme based on price and volume. Well, maybe not so much extreme, but still quite negative. The percent of rising PMOs, that is extreme negative, as are the buy signals, and we're declining with those PMOs above zero. We're also seeing this on the daily charts. RSI still has some more room to go before we hit an oversold condition. Special K still continues to rise for some reason. Stoke RSI, extreme negative. Williams percent are extreme negative. Vortex still kind of bouncing around like a bumper car. The green line's up above just a little bit here, but it's not really picking up the downward action that we've had. Ultimate oscillator declining. Money flow indicator down. Bollinger Bands declining and not necessarily extreme. The KST, which was trying to show some improvement, if we see more follow through downside, that will eventually roll over. Where the PPO, the percentage price oscillator, it has switched back now to negative. After the first time in a long time giving us a positive signal as we were going up here, well, it's given all that back now. Rate of change going back a week, we were pretty much flat, even though we were down 4.65%. Going back a year or 50 weeks, we're starting to get extreme negative, but we could still go further to get down to where we were at during the COVID lows. The Copic curve, we're starting to lose that signal. See how we crossed right here, and then we had a nice little run up. Well, as we've been coming back down, the Copic curve is saying, I don't like this anymore. Here's our longer term fib chart where we broke through the 38.2% retracement. We're falling down. We might come down to this long-term moving average. If we fall through that, then we get down to the 50% retracement at 35.07. Our different charts, the Heiken Ashi is negative. The Kegi is red and negative. Renko, red box, negative. Ease of movement, going back 1 week, declining. 14 weeks, also declining. We had some new zeros drawn in on our point and figure chart, and we have a triple bottom breakdown. Yeah. All right. Our 3-line break is negative, and see how we're coming down and testing the low set in June. Our Elder Impulse system is negative. Parabolic SAR switched back a week ago, and it continues to be negative. Where just a blank look at the S&P as we're declining and coming back and testing this low, we're also coming down to this level with the mid caps, and we've actually broken to a new low with the small caps because they've been seeing a lot more weakness. All stocks continue to be declining. Mid caps declining and in a downtrend. Small caps declining, downtrend. Dow declining, downtrend. It actually did set a new 52-week low. NASDAQ declining, downtrend. NASDAQ 100 declining, downtrend. NYSE declining and breaking down through support. Wilshire just about at support currently, but in a downtrend. The FANG stocks showing some weakness, down 5.18% on the week. ARC, which keeps trying to come back up here, it was down 11.16% on the week. The biggest software companies continues to be in a downtrend. Here's a look at Dow theory, where we're coming down and finally making a lower low with the Dow, where it had been some days where the trannies were making lower lows, but the Dow was not. And so that was a negative divergence, especially since we're going down. Utilities, although they've been declining, they are not coming down and making a lower low. Now, I use utilities as part of Dow theory, where most folks probably just use the Dow and the trannies to compare with each other. Broad market, here's the Crb Index. It is really starting to roll over. So now commodities are looking less strong than they were not so long ago. They're still in an uptrend, but we might see a death cross here soon. Copper is down a little bit, still in an uptrend, but is showing some weakness. Gold, which should be just going up and up and up, continues its overall strong downtrend, mainly due to the dollar. Silver has really been in a decline as well. Oil dropped below 80 and closed at 78.74. Here's the dollar, which is bam, just take me to the moon and just keep going. I have it here at 112.96, almost at 113. Looking at bonds, they continue to really show weakness based on price. And look at this. This is the blue line. This is the 3-month yield. It's the highest right now. Is that crazy or what? Where the 30-year, you want to type your money for 30 years, you're going to do worse than the 3-month, the 5-year, the 10-year, and then you'll get into a 30-year bond. It's like crazy right now, but we're seeing longer maturities really go up as shorter maturities are coming down, at least on that chart. Here's internationally, where the US and the UK, they're almost neck and neck with rates. And we have Germany raising rates. And then here's Japan with their problems continuing to go sideways. Intermarket analysis. This is the freaky chart. See how oil just been going up and up 30%, 40%. It's still up just under 20%, but look how it's really been coming down. The best investment this year has been the dollar. At least it could be. It's almost getting ready to pass above oil. Where we have gold, stocks, and bonds negative. Going back to the beginning of the year, bonds have actually been outperforming stocks a little bit in the shorter maturities, where we look at a monthly chart, and stocks had been outperforming better, but both are really having trouble right now. So we're seeing a little rollover in this chart. Gold, which should be going up, and the dollar, which should be going down, are doing the exact opposite. So that's why we're seeing this ratio really decline. Gold to the S&P, since gold is not really doing well and the S&P has been doing even worse, gold is starting to outperform a little bit. Low volatility stocks, this is the place to be when we're really headed down. They have resumed their uptrend. Growth, which had been trying to recuperate against value, well, now growth is really going down. NASDAQ 100, which is growth against the rest of the S&P. The NASDAQ 100 has been underperforming. The S&P 100, which actually had been holding up fairly well, but it's still in an overall downtrend. Discretionary has really been showing some weakness over the last few weeks. Energy, which has also been getting weaker against tech, which has really suffered a lot this year, still in an overall uptrend. But if we see the energy sector really continue to decline, this ratio is likely to fall more. So then what's our outlook? The reports coming out this week, we have none on Monday. Tuesday, we have durable goods, the housing price index, and the Case-Shiller home price index. Getting some more real estate and housing information this week. We will get another reading on consumer confidence, and we'll get new home sales. Wednesday, we have pending home sales. We have the weekly report that comes out about the mortgage applications index. On Thursday, we have jobless claims that we have every week, GDP third estimate now. And then on Friday, we have personal income and spending. And then this will be the biggie. This is the other inflation report, and the one that the Fed likes to use. That's PCE prices. Then we'll get the final reading of consumer sentiment. So our technicals, yeah, can you see we're kind of negative right now because of inflation and interest rates and because of Fed speak potentially now, because they already gave it, and then Fed policy. It's just really causing a lot of problems in the market. So our scenario, this is just made for Monday, September 26th. We can't really go with the down scenario full on because we're very oversold in the short term and even quite a bit oversold in the intermediate term. So going short doesn't necessarily make a lot of sense right now because we might get some kind of a bounce, but we can't really go long because our technicals suck. But we may get some kind of a bounce from that. But our scenarios are all on hold. We're below all the moving averages. We've been breaking through support and our pivot levels and our fib retracements. There's just not a lot to hang on to right now. So we'll have to see how things work themselves out. And we can't go sideways because even on the daily chart, the ADX is above 20 and the red line's on top and it's getting stronger. So yeah, we have to default with the negative scenario or the down scenario, but because we're so oversold, it's kind of hard to really be convicted about using that scenario right now. So thank you. I hope you found this useful. I do have a full-length daily video that you're more than welcome to watch, and I will also be posting the intermarket analysis video here very soon.